Hello, everyone. Welcome and thank you for signing in to the KredX webinar on the topic Building Resilience, How Startups Can Prepare for Market Downturns and Reassure Investors. I'm Devang Mundhra, Chief Technology Officer at KredX, and I'm happy to be your moderator for today's discussion. KredX is a supply chain finance and a working capital platform. And we work with startups as well as other businesses. In today's rapidly evolving business landscape, the ability to navigate through market downturns and instill confidence in investors is essential for startup success. We have seen a lot of changes that has happened in the economy, in the markets, in external circumstances over the last couple of years. And startups, some sectors of startups have done very well. Some sectors have got hyped up. We've seen downturns. So apart from product, startups have had to deal with a lot of market volatility. So the topic we are addressing today is not only timely, but also crucial for startups looking to thrive amidst the recent economic uncertainties and volatile market conditions. We are very privileged to have a distinguished panel of speakers who bring a wealth of experience and expertise to share on this topic. First, please allow me to introduce Mr. Sandeep Agrawal, co-founder and director of TeamLease RegTech. Sandeep is an expert in governance, risk, and compliance space, and has worked with large corporates in India and globally in helping them strengthen their business and compliance processes. Joining us next is Mr. Gaurav Singh, founder and CEO of BlueStone. As a seasoned entrepreneur, Mr. Singh has navigated his company through various market fluctuations, making him well equipped to share practical advice on reassuring investors during downturns. Last but certainly not least, we have Mr. Eshan Kaul, Senior Vice President at JP Morgan. With his deep understanding on the financial markets and investment landscape, Mr. Kaul will provide invaluable perspectives on how startups can maintain investor confidence amidst market uncertainties. Welcome, gentlemen. So without further delay, let's delve into our discussion. Over to you, Gaurav. You can probably start off by first explaining to our audience what, according to you, is a market downturn, and is the Indian startup ecosystem experiencing one right now?
So you said market downturn, is it, Devang?
Yes.
Yeah, so, okay, so I've been in the startup. So hi, everyone, I'm Gaurav Singh, founder and CEO of BlueStone. So I've been an entrepreneur for almost 17 years now. I started my first company back in 2007, and BlueStone I started in 2012. So I have, over past almost 17 years, I've seen at least 3 to 4 such cycles. And I would say the first cycle started in 2010, 2011, where the funding boom had happened, and the category to gain most out of it was the e-commerce categories. And we had lots and lots of e-commerce, niche e-commerce players, etc. So typically, the pattern that I've seen is 1 or 2 sectors get suddenly become favorable with investors. And I think the money that then flows into those sectors is kind of becomes disproportionate. And then some of the course correction that happens post facto. So, and the last funding cycle that we saw was during the COVID times, around 21, 22, and so on. And I think what we are seeing right now is kind of a correction. And what got excessively hyped up during the last cycle was the growth. So it was not a very category specific cycle, but it was more about growth at any cost across different verticals, across different categories, which was getting disproportionate. It was getting disproportionate focus. And I think a lot of that was also led by the fact that many of the businesses or many of the rules of the games actually dramatically changed during COVID phase. And many folks believe that a lot of these have changed for good. A lot of these are going to persist even beyond the pandemic. People had no idea how long the pandemic would last and so on and so forth. So I think it became very noisy. All the data, etc., became very noisy. It became very difficult. It became very difficult for people to predict the future. And I think growth got overvalued there.
Okay, right.
And I think that course correction is happening. So what I'm seeing currently is that it's not that the funding is not happening. People are just trying to kind of recalibrate that focus. and the focus is back on profitability along with growth, or say path to profitability, or on the fundamental unit economics, etc. Some of these things were not even being asked around a couple of years back. So I think most of the good businesses, businesses that had solid fundamentals, let's say before COVID and after COVID, I think many of those businesses are thriving. And in a way, it's good for those businesses because those businesses were actually struggling a lot in that whole noisy period.
Yeah.
And in fact, in many of the cases, what I noticed was businesses that kind of had an established model, who were kind of in their growth phase. During that phase, they were having to do things that they fundamentally believed was not right for the business. But because the capital was chasing that, they had to chase those things. So in a way, I'm saying controlled capital is good for such businesses, good for entrepreneurs who are actually building the businesses the right way. So I would not call current one a downturn. It feels like a downturn when you compare this level to the level that we had seen around 2 years back. I think funding, if you remove that peak from all your data plots, etc., it is not that bad. If you compare it to 17, 18, 19, it's not that bad. Just that people are asking the right questions, right fundamental questions, which they stopped asking 2 years back. And hence it looks like an anomaly, but it's not.
Got it.
This is the normal. I'm saying that was not the normal.
So we have regressed back to the normal now. Right. And adding constraints is always good to help foster creativity.
Yeah.
Great. Yeah. Thanks, Gaurav. And so Sandeep, as per you, so a lot of startups, were caught off guard when COVID happened, when this like the non-market but still a market downturn like kind of feeling is there in the large part of the ecosystem. So how would you suggest startups can be more proactive, and what is the importance of being proactive versus being reactive in during market fluctuations?
Sure, Devang. See, being proactive is basically an attitude for any management. I mean, irrespective whether I am a startup or a mid-size company or a large company, the management have to be proactive, and it's more of a strategic thinking and forward-looking thinking for any decision making or problem solving. It's very important for startup because anyway, startups struggle with a lot of challenges, right? A lot of startups' business model is based on a lot of assumptions. And with small change in the market scenarios, some of the other assumptions also goes for a toss. And with one or more assumptions going for a toss, the entire viability of the business also is sometimes becomes questionable. So it's very important for any startup entrepreneurs to be more proactive. I mean, when we say be more proactive, is basically anticipating what can go wrong in future, building all of those thought processes, or you can actually simply look at it as a risk management. Identify risks which can impact your businesses in a long term or a short term. Identify the probabilities of these risks, and then also basically the impact of these risks. So, I mean, you have to think of actions specifically for high probability, high impact, or low probability, high impact areas. And, as a startup, there are a lot of benefits for that as well. I mean, since a small change in the market impacts you, I mean, it helps you also to adopt well. So if you're able to anticipate market changes well in advance, you can adopt your strategies accordingly, and that's where you become or you stay competitive. A lot of times market fluctuations also brings in opportunities. Being proactive also helps you identify such opportunities well in advance so that you actually act on it before your competitor does. So it can be on the right side of the table, where it's just that not every downturn actually brings opportunities, but whenever it has, you should be able to identify them. From a risk perspective also, you should be able to, being proactive helps you identify your risks well in advance early on, so that the right steps helps you mitigate the negative impact of these downturns well in advance as well. And very important for a startup is basically to sustain for a very long term. What I've heard from my investors is basically the longer you sustain, the chances of you succeeding in your businesses is very high. There is a time frame. If you stay, I mean, if you sustain for a long time, there is a chance that you get lucky and you will survive the business. So being proactive actually helps any startup to become resilient and helps them sustain for a very long term. So, in a nutshell, I mean, it's a basic nature for any leadership basic prerequisite, I would say, for any business to have in their leaders. And I think more so important in any startup entrepreneur as well.
Right. Although just one follow-up on that. So as you mentioned, like being proactive and identifying risks is important, right? And at the same time, startups also work with very limited resources to begin with, right? And so do you think there is value in just identifying risk, but not having taken action on it? But does identifying risks also, like the value of identifying risk comes from having taken actions to mitigate risks if those probabilistic events happen?
So there are two different ways of looking at it. Not every risk you need to act on it today, right? What is important is basically, if you have identified risk, have you thought of what you would want to do when it materializes, right? So you have thought for it, and you're prepared, not necessarily prepared as in you have taken actions, but you're prepared from a thought perspective also. So from every company's perspective, when I say risk management, actions are taken specifically based on risk metrics, probability and impact of any risks. For startups also, because there are too many constraints, you can't actually pick up every risk today. But if you have thought through it, and you have thought of, in case a particular risk materializes and an event happens, what are options do I have? If I've thought through it well in advance, possibly I don't spend more time panicking about it when the event happens. Right? So you're absolutely right. And being a startup myself, I know I have thought of a lot of risk, but I can't take up every risk from an action perspective. It's just that we have thought of it, we have discussed it internally, brainstorm it, and we may have an action plan available with us, which can be taken up immediately when we think it is getting materialized. So you don't have to struggle and panic probably the time when it is actually materializing.
Makes sense.
But Devang, on that part, Devang and Sandeep, sorry, Eshan, I'm just cut.
No, go ahead, please.
So essentially, so Sandeep, I'm with you on that. And what I've noticed is there are generally not too many type of risks, but a broad classification. You see, in my experience, what I've seen is there are operational risks. Right? So let's say gold rate goes up and people stop buying jewelry as frequently or as much as they are buying. Let's say some rain somewhere or something related to seasonality, etc., etc. I'm saying those are operational business risks, and let's say business as usual. And what I've generally seen is, let's say the impact and the kind of the risk planning that you need to do for those is kind of very range bound. In the sense, 10%, -10%, 20% here, 20% there, and so on. And I think specifically about when we talk about this funding cycles, etc., what I've seen is the extent of those is actually very extreme. In the sense, when in that upturn or in that boom time, most of the people, it just feels it's very difficult to even imagine that you won't get those multiples, that the moment you call someone, that person will not even give capital to you. Suddenly the capital will be so scarce that 400 million sitting in the bank would actually feel like nothing, or that you'll not be able to actually take that 400 to 1 billion, or that 40 to 100 million and so on, or that 4 million to 10 million. It's like whosoever is in your network is just getting funded. The guy who started 2 months back is getting funded. Everyone is just getting funded. So I think at that time, to say that, to even feel that there's a risk that suddenly all the capital will run dry, it's very, very difficult. And vice versa also. In downturn, I've seen many of the beautiful companies getting shut down in the downturn just because last 1.5 years, etc. It just feels like it would never end. And so basically, it's actually very difficult. And I've seen it in many cases, many scenarios. I've seen companies, especially in the downturn, I think that pains a lot, that if they had waited for just one more year, which is coming back to your point, Sandeep, if they would have just waited for one more year, there would have been more sanity. And they could have actually, and that's why I'm saying, I think managing operational risks or business as usual risk is something that becomes very natural when you're running the company. It's these other cycles that actually are very blinding, not only for entrepreneurs, for investors, for everyone, for the whole ecosystem. That actually is very difficult to do.
I agree.
Eshan, you were saying something.
Thank you so much, Gaurav and Sandeep. So I have my own personal framework and something I advise to startups as well, especially something that, in my opinion, potentially insulates them from market downsides, right? So it's something that Paul Graham has suggested, which is the concept of whether, as by default, your startup is default dead or default alive, right? And your default dead, if assuming your revenue growth continues at the same rate, your fixed cost and variable costs continue at the same rate. If tomorrow you weren't able to raise even a single dollar of capital, say in the next 2 years, 3 years, 4 years, would you still survive or would you be dead? I think when founders start thinking of that question, not necessarily at Series C and Series D, but from the seed and the and Series A and early stage itself, I think then bottoms up founders will start thinking of cost optimization, of revenue sustainability. So I think that mindset of whether you can still survive without external capital will potentially help you build in the right contingencies. So if that bad day comes, if another COVID comes, if another financial crisis comes, you potentially have the right mitigation plans in place so that you have the cushion to absorb those shocks. So that's something I recommend to a lot of folks.
You are absolutely right, Eshan. It's just that it all depends on which stage a startup is. If you're pre-revenue, post-revenue. If you're pre-revenue, it does not hold good because you're still trying to productize your idea. Post-revenue also, whether have you actually reached a break-even or not reached a break-even. So those are practical aspects. This is absolutely fine. Financial prudence is absolutely important for any startup. It's just that if you've started generating revenue, if you've touched break-even, at this point, basically, this thought process has to be adopted. If you're generating cash, how do you use them? Invest, and to what extent? What risk do you want to take? So I think, but it's quite tricky. I mean, there is no one way or the other way. It's basically every startup depending upon where it is and what market is impacting and which way. I think the position differs for every individual company as well.
So I think after certain maturity, these numbers hold. I have seen some of the companies which are which are just starting up and they can't even project their revenues to 4 years. It's an exponential graph, doubling every quarter. Right? So in 4 years, it will be 2 to the power 16, which would be, they can't even raise that much capital, for example. So it's just, sometimes it does not, especially in very early stages like pre-revenue or when it's very, very early, because those graphs are outrageous.
So in that case, would the suggestion, because I think Gaurav, you do angel investing, I believe, Eshan, you are also a venture partner. So do you kind of suggest companies to try to get to break even as soon as possible? Or, has the suggestions to companies changed over time, right? In terms of, trying to capture more market or versus, try to, focus on something, but try to get to break even as soon as possible. Have these suggestions that, as investors, as venture partners that you give to startups, have they changed in the last couple of years?
I can take a quick shot at that and then I'll open up to Gaurav and Sandeep for that. I think there's no silver bullet or there's no one size fits all approach, right? I think it really varies case to case. For me, my personal thesis is that if you're in the distribution business, right, it is extremely important that your variable distribution cost, right, it does not really exceed, the amount of money the amount of revenue you're generating as a sale of that, right? So essentially, I'm talking about your CM2, right? Ideally, I always advise startups that the amount of money you're spending to sell the product, right, you should be able to recover at least that much from the revenue. As far as wages expenses are concerned, branded expenses are concerned, which can be called as fixed costs, it's still okay. But in the long run, your CM2 has to tend towards zero or has to tend towards positive, because when you move towards more maturity, it is that contribution margin which will offset your fixed costs, right? So that's a mathematical model I tend to go by, but I'm happy to hear Sandeep and Gaurav's opinions.
I think CM2 is absolutely must for any company in a longer term. I think the dilemma for investors as well as entrepreneurs is basically when you start generating some money, how do you use that money? Do you want to maintain certain reserves for market downturns? Or do you want to be more aggressive and start investing on certain areas? It can be marketing, it can be sales, it can be more products. So continue to invest. Where to invest is basically a question that, again, as you rightly said, will vary from case to case. If you are a company where the products are absolutely great, there is no player in the market, you're trying to generate a market, I think more investment is what every investor would like to actually push. Again, the problem statement between investors and company would be valuation. So I think it varies from case to case, but I think decision making around fund utilization and where it is getting invested is very important. capital frugality is something which I kept hearing from TeamLease when they invested in us for several years. And as now I'm hearing from them, why don't you invest more? So I think the stage varies, the thought varies. So if you're an early stage entrepreneurs, capital frugality is a must. You have to be very careful on where you're putting your money on. You need to, stay up for a very long time unless you are self-sufficient. So जैसे ईशान ने बोला, once you are self-sufficient, then I think you can take those risks. And now, but that is also very important. So you have to have the right plan from a utilization. You know whether you are able to recover the right ROIs from the investments that you're making. You should not diversify significantly, so you're stretched too thin. So I think again, case to case basis, these discussions will vary significantly.
Yeah, I think all these rules change between REIT cycle and the downturn. In REIT cycle, let's say if you are running your business very, very frugally, very, very prudent, in a very prudent fashion, but there is some other person who starts doing the same business, starts burning capital a lot more than you, but creates a business 4 times in your size. Then all these hedge funds, all these tourist investors who come into the India during those cycles, they would actually pick that person and load that person with 20 times more capital. And you might actually just be, he might just outprice you out of your business at that time. In the end, he might also die. But I'm saying in the process, you might also die.
And that's absolutely true.
So it's very difficult. It's very difficult to do that. So I think, and there are very few such entrepreneurs who actually read these cycles which are happening in the market. Let's say the capital cycles, but they themselves don't start smoking their own stuff. So they themselves don't start believing in that. If there is some such person, that person can actually navigate this very well, very, very well. Because in that cycle, that person can actually change the gear and take a lot of capital. But don't blow that capital. I'm saying save that capital for the rainy day.
Right.
And then build your business the way you are building. I'm saying don't alter the fundamental fabric, the DNA of the company. Don't alter the nature of the company, the nature of the people, and so on. Right? But if you need to push the pedal and go at a higher speed just because the cycle is such, and you don't want to be the number 3, number 4 player, because sometimes just being number 3, number 4, despite doing all the things wrong, right, can also wipe you off. So you have to stay there, but don't, like I said, don't smoke your own stuff. The moment you see that the cycle is coming down, hunker down and then just kind of go for the long race, and with all that capital. So if you can actually shift gears very, very quickly, you can go to first gear, fifth gear very, very quickly, depending on how the market cycles are. And if you're able to create an organization that can actually shift gears, I think you can navigate those cycles very, very quickly. And it's very important for that person to stay level-headed. During up cycles also and down cycles also.
So that's a very interesting point, Gaurav. And so I think I'd like to double click on that. So, what you mentioned is that it's very important to kind of read the market and the ecosystem and, where we are, like whether there is bull, there is like capital available or not, because that can often, give opportunities on, kind of make opportunities for a company. So are there strategies, are there kind of analysis, kind of databases? How would you suggest, a startup, and this question applies, goes to everyone. Like, how can a startup actually try to figure out like this volatility, where in the hype cycle we are, so because that is the first step to be able to then see, okay, how should we take action on top of that?
Yeah. So let's say if you have been in a business for 4 or 5 years and so on, I think all these hype cycles apply to your capital structures, not to your consumer behavior. Consumer behavior is not going to change. So if you have a fundamental, let's say, price elasticity that you are aware of based on pricing, etc., that you know that your customers or in your category, this is the price elasticity. If you drop the price below margin, this is how customers behave and so on and so forth. Now I'm saying, let's say if you have done your business well enough, you've understood all these aspects of your business well enough, and let's say a greed cycle comes, then you can actually tweak some of these things very, very judiciously to hit the pedal on growth. And I'm saying corner a lot of capital using that. But you yourself have to be aware that this growth is not a good growth. There's not quality growth. There's not going to be there the moment you actually switch the business back to the same gear. So if you can have that kind of maturity and that kind of understanding of your customer and your category, you can play those cycles. But what also happens many of these times, the founders, the entrepreneurs trapped in these cycles are first-time entrepreneurs. Or let's say people who just started the business 1 year before the cycle, greed cycle, etc. So it's actually very difficult. But if you're, so let's say what I'm saying is, let's say EVs, right? A company like TVS, Bajaj, etc. They would know about those businesses very, very well.
Right.
What price sensitivity, at what price, how do customers react, how much of it is organic demand, how much of the demand is coming just because of extra sobs that you are giving, and so on and so forth, right? So while your business size might be X, the business side visible from outside, the size of the business visible from outside, or let's say that your real revenue numbers are X, knowing that my actual business in a stable state without all this mumbo jumbo that you have done is X by 2 or X by 4 or whatever, 0.4X.
Right.
Knowing that viscerally, knowing that very, very intimately, I think is something that can help one navigate these cycles very well. Sandeep.
And this,
I think again it is case specific. I mean, situation to situation varies significantly. I think these are decisions which differs from space also. Which space I am. So I mean, a lot of times it happens. It's not consumer. It's a B2B business. Again, it works quite differently in a B2B business as against a B2C businesses as well. So again, these decisions. And Devang, coming to your questions on, is there a data tool available or data analytics available? I think a lot of times it's quite difficult because you are in a dynamic environment. You need, I mean, being proactive is basically this, where you're aware of what's changing in the market and how is companies in your space, what is your competitor doing, or anything which impacts your business, how is it going? So if, let's say for me, I'm basically into RegTech, which is regulatory space. What's the mood of regulatory environment in India is basically should be driving my businesses as well. So again, case to case, business has to think of every areas which impacts their businesses, keep a track of that and be aware of it. There is no ready tool or data, I believe. I have been into automation for a long time with Big Four, but when you run a businesses, I think to understand dynamism of any market environment, it's basically you need to be open and you know the areas, I mean, in your business. So you know your space very well rather than actually depend on a third party to tell you what's going on.
Okay. And Eshan, you've been, you're part of one of the largest banks in the world, and you've also been in you're a venture partner. You work with a lot of companies, startups. So are there like financial strategies, again, toolings, dashboards, forecasting, etc., that you see that has been helpful for startups to kind of be more proactive, address any potential challenges that might come?
To be honest, Devang, I'm a big fan of keeping things simple. Although there are multiple SaaS tools available in the market, but I think it basically boils down to the basics, right? It basically boils down to finding ways in which you can extend your runway, finding ways in which you can cut your fixed costs, finding ways to reduce your burns. A lot of those calculations are very intuitive and can be done on Excel sheets itself, right? But I think in terms of broader strategies, so one part of it is the data, right? And the second is what do you do with the data? I think the top 2 or 3 things I would want to do is as we mentioned, looking at reducing the amount of money you're burning. Secondly, I also want startups to be more proactive about looking at diversifying their revenue streams, right? In terms of not just depending potentially on one segment of customer, but potentially also looking at other avenues like looking at the same market, but a different segment of the same market, potentially even looking to enter a different market or targeting the same customer via different channels. So I think those are some other things that a data strategy can help an organization achieve, right? Like one of my favorite companies is Airbnb, and if you know the history of Airbnb. So Airbnb wasn't the first mover. The first was a company called as Vrbo, right? They were the ones who had the lead in leasing accommodation places, but Airbnb was able to win because they had an excellent data strategy. They were able to use predictive analytics and machine learning to find out the discrepancy between the supply and the demand, and to find the right prices so that the prices are high enough that house owners are incentivized to put them on lease, but still low enough that hotels don't compete with them. So yeah, long story short, data strategy would be would be a very important cog in the wheel for any organization that wants to preempt a disruption.
Got it. And Gaurav, a similar question, like, are there like you've been running BlueStone for 12 years now, almost 12 years now, right? Are there kind of dashboards, metrics, tools or forecasts that that you have like that is kind of your Bible or Gita, or like so that is basically the first thing that you see, and like are there any recommendations that you would give to startups in terms of what kind of things to build, like some which might be very business specific, but some which might be more generic. I think you might be on mute, Gaurav.
Yeah, Devang. So we've been in business for almost 12 years. So our data, our reporting, etc., is kind of very, very, very mature. So I'm saying all the business data, all the operations data, all the system data, etc., everything is there. And we also use a lot of automation, a lot of machine learning, etc., to take a lot of decisions. For example, in our business, one of the most critical things is we have 200 stores now with offline presence as well. What designs to keep in what stores? I think this is the make or break for our business. Like what Eshan said for Airbnb, the problem statement or the holy grail was different. For us, this is the holy grail. So all this can actually only be solved by data. At that scale, putting humans there, because humans take time, right? Humans, okay, so humans also. So there was a time when humans would take a lot of these calls viscerally, right? What they have learned over generations, when the data tooling, etc., was not as mature, as straightforward as it is today. A lot, and let's say 45, 50 years back, right? There's hardly any data. So a person with 30 years of experience would actually build a great intuition in a particular category. And then that person would be a lot more valuable.
Yeah.
Then let's say a person with 10 years of experience. But the flip side of that was that if the consumer behavior changes very, very drastically within 10 years, such a person would not be able to react. So 30-year-old person there might actually be turns out to be worse than, let's say, a fresher. If consumer behaviors are changing that rapidly. Now, those were not changing. 40, 50 years, the behaviors, the technology and everything was not changing that dramatically or that rapidly as it is changing now. Right? Those cycles have actually accelerated. So behaviors, and in 15 years, maybe behaviors have changed completely. I remember those early days of 2006-07 when people used to say that who will buy books online. From that to buying almost a lot of things online. It changed in just 15 years, 15, 20 years. There are no smartphones. Now there are smartphones. The times people are just glued on their screens, watching reels, watching TikTok and whatnot, right? And that's kind of very, very, very prevalent. TV is suddenly out of fashion for a lot of stuff. So I'm saying now these kinds of, if we just look at the number of behavioral shifts that have happened in the last 10 years, I don't think the same would have happened in, let's say, 50 years prior to that. Now, in such a changing world, data is the only thing that will actually change as rapidly or in line with what the behaviors changing. And hence, if you're taking the calls basis data, then only you can actually survive in today's world. I think so if we go back 50, 60, 70 years back, it was all visceral calls. There was no data. There's hardly any data. In last 10, 15 years or 15, 20 years, there was a lot of data, and then you needed people smart enough to analyze and generate patterns out of that data. Now we have machines reaching the level where actually they themselves will extract the feature sets of the patterns out of that data. And you just need to apply that back into your business, or you can actually have integrations to that extent where the machines themselves can take the call. For example, in our case, it's the algos that actually decide what design goes and sits in what store. We don't have a single merchandiser, which is unheard of in our industry. So I think, so I think data taking most of these calls, and in many of these cases, actually removing people also. So a while back, the data would actually tell you a few things. but you would still have humans actually looking at those calls, looking at that data that the machine is generating, and then taking calls based on that. Now, I found that also to be kind of a little problematic in our use case per se, because humans would then actually modify those learnings to then match with their instincts. And hence we removed humans completely from the process.
Switching gears a little bit, Sandeep, there like in the ecosystem, while has been a market downturn, like on the regulation front also, there has been a lot of discussions, whether it is EV, whether it is fintechs, like a lot of different startups are now very clearly and clearly being impacted by regulation. Like there has been like talks about regulations on Gen AI, usage of like on e-commerce, etc. So, what is the importance of adhering to regulations and compliance, while navigating the market downturns? And what are your thoughts on the collaboration between regulators and startups?
Okay, so I think the first question, I think irrespective of downturns or no downturns, every company have to be compliant, right? So, I mean, you have to adhere to the law of the land. I mean, whether I am a startup, again, any type of company, any size of the company, you have to continue to adhere to the law. Of course, the environment keeps changing. I mean, online gaming came into picture, and then the regulator realized that, I'm not generating any revenue, and I changed the, so it disrupted the model, of course, the way they were working on it. Similarly, I think SEBI realized, and they are now getting much stricter on, let's say, AIFs and any other, financial institutions structuring. So I think, and this will continue to happen. I mean, everybody is evolving. The way the businesses are evolving, the regulators are also learning and then evolving. So it will continue to happen. And as an entrepreneur or be a startup or any other company, you have to ensure that you have to abide by the law of the land, right? So there is no way you can actually bypass any law and then you continue to sustain in the business. So it is, I think, very important. I would say a lot of large companies, the boards and the management are very clear and have budgets set aside for creating processes on compliance monitoring, right? They have adopted technology to actually be on the right side of the law and at least have a process to keep a track of what's going on in their company. So I think, and that's the flow. I mean, I am expecting more and more companies to become more stricter on compliance adherences. India में पहले होता था, it's चलता है, we'll manage as and when the notice will come, I'll take care of it. Well, I think it's not now not norm. The companies are not really keen to have that model कि जब आएगा तब हम देख लेंगे. Now they need to be proactively managing their compliances, and then they're now having dedicated teams, resources, investments built to actually ensure that they're aware of what's going on. It's getting reported also. So a lot of companies have kept it as a part of the KPIs for senior guys to ensure that the department is actually compliant. So now coming to, can private sector collaborate with regulators? Definitely yes. And there is a huge opportunity, humongous opportunity for regulators to also adopt technology. I mean, what recently we have seen is just, let's say, GST. What I remember of, where finance ministry opened up and they actually invited a lot of private players to invest in technologies, so that corporates, instead of actually, or rather regulators, instead of investing a significant portion of the technology, it's actually being designed by private players, and then it's integrated to the regulator platforms, and then and then the investment is basically by corporates to integrate with the platform supported by or offered by these vendors or empaneled vendors. Now that is just a couple of examples where you're saying that a lot of regulators today have not thought of it. There is huge opportunities for regulators to actually shift from what they have been doing today and then shift to technology. A lot of redundancy in data also multiple departments are asking. The same set of data might be asked by finance ministry and also probably by labor ministry, but possibly certain set of informations are quite common and can be actually looked at and passed on to different ministries. If you look at examples, if I am a listed company, I generally are listed with both BSE and SE. I actually have to file separately to both the exchanges, the same data points. So objective is that there is a huge opportunity where collaborations can happen. Unfortunately, private players have not yet invested in RegTech. Specifically, they are not clear on how is government behaving. The intent has been shown by regulators, but there is no concrete actions yet defined by them. So, I mean, just to give you an example, we won a challenge by DPIIT in Startup India under Amitabh Kanji in 2019 for labor compliance automation in India. And the thought was that we will continue to work with Labor Ministry in helping them design a solution which can automate the entire compliance creation and submission for MSMEs. The thought was that it has to be made free for MSMEs. We designed it and thought of it. In spite of winning the challenge statement, I think till last year, there was no response from Labor Ministry. Now, fortunately, it all depends on the person sitting in that ministry. Somebody changed at the ministry level and they came to us last year and we got an in-principle approval that will initiate that discussion of integration, right? On the similar lines, I think the SEBI chairperson, when they came in, she was very aggressive and she also came into us and then say, why don't we work together in digitalization? And but it's just two regulators I'm talking about. There are many regulators if you look at it, and there is a lot of work and a huge amount of potential business opportunity for private sectors also from an investment viewpoint, which will significantly reduce the compliance burden on corporates, significantly reduce the compliance cost of compliance for any company. It's just that that green signal has to come from regulators. So regulators have to actually be more open, talk about it, and then ask for private players to collaborate. I think it's a huge opportunity lying there. I'm sure, just like any new opportunities comes in, a lot of players jumps into it. I'm sure when regulators are ready for it, and there are more and more players in RegTech space will actually get increases. Today, there are very limited players who talk about regulatory automation or compliance automation. I would say I'm the only company in India who can actually talk about automating compliance for 3 regulators today. We have not gone into finance. We have automated every labor compliance. We had automated sectoral compliances. I think we chose 5 years back these 2 regulators because every company is required to do labor compliance and sectoral compliance or an MC compliances. And then since SEBI came into picture and they on their own approaches, now we have started working SEBI compliances. I mean, probably 50% of the SEBI filings have been automated by us. So I think we are the only company, and I'm sure many companies would like to invest, but still as a PE or a VC, you would not like to invest unless you know clear outcome or the number of years it will take for a RegTech company to actually start generating the ROI. And then TeamLease being a strategic player, we are sure that 10-15 साल लगेंगे India में तो. But no I think PE or VC will wait for so much. Yes, that's where there is lack of investments in the sector. But I'm sure huge opportunity. It's just that when government wakes up and then possibly decides to move forward, although I could see intent at a PMO office, it's just that the implementation has to happen at an individual secretary level or a ministry level. Yeah.
Thanks, Sandeep. So moving to, given we've been also talking about market downturns, moving to funding sources, what are some of the funding sources or diversified funding sources that you could suggest to startups? Like for example, at KredX, one of the products that we have is an invoice discounting products. And a lot of companies, a lot of startups, we work with a lot of startups also to help them, get liquidity on their unpaid invoices so that, that they can manage their cash flows better. And that is just one of the options, on alternate funding sources. So, a question to the panel, and given there can be different approaches to it. Any suggestions or thoughts on, apart from kind of VC or equity funding, which is known to be kind of the most expensive form of funding, giving equity for money? What are the some of the alternate funding sources that you might want to suggest?
I think it all depends. How is the agreement with your VC and PE? Once you have VC and PE into place, I think there is very little room for an entrepreneur to take decision where to fund the company from. And that's my personal, I don't think it's my personal issue. I think I'm facing that, but is possibly, and it's right from their perspective also, they would like to actually control who comes into picture from a shareholding perspective. So I think if you don't have VCs and PEs on your board, I think there are many other opportunities as well. But if you have them on board, then very limited choices, unless they want to only continue to fund you or they allow you to take it from outside. If they allow you to take it from outside, I'm sure there are a lot of terms and conditions which they will have a veto right. So, I mean, I mean, companies will have constraints on going outside and, look out for it, unless you are going to another VC and other VCs are also okay to fund, and this VC is also comfortable with the other VC. So it all depends on case to case basis. But assuming that you're open and you have the approvals, I think debt funding is one way of getting into it. Equity backed debt funding, a lot of times VCs and PEs will not allow for it. But let's say I don't have anybody and it's a self-funded company, I want to raise capital, and you're right, cost of capital is way too high in actually when I have to dilute. A lot of players, private players in the market, if they're comfortable with you, you know them from a circle perspective, they will be able to actually fund you based on your equity backups also, provided you have enough credentials that you will be able to repay to them. Companies like you are definitely saving grace for companies like us. I didn't know about you. I should come back to you for how to use your services. But yeah, if you have working capital issues, I think bill discounting facilities or any other structuring, I mean, any other utility available like this definitely helps take care of the problem statements for small companies. Although there are laws and under MSMEs for getting funds within 45 days is basically not happening at all. I mean, it's just a law being bypassed by a lot of corporates. So I think one solution is that self-funding. If you continue to self-fund, so if you have enough backups available, I think that's the best idea. If you are able to generate funds from any other business which can route to your new startup, I think that is another way. Banks becomes very difficult. I'm sure everybody knows it. If you have collaterals, then you can go for it. Otherwise, banks is not a viable solution at all. Anyways, you're taking a lot of risk in continuing with a startup. If you have clarity and if you're confident that this startup will continue to go, instead of actually going to a VC or P, we should go for debt funding. But if you're doubtful, I think VC is a good option.
Yeah. If there's a lot of risk to the capital, I think VC and equity funding is better.
Absolutely.
So I think over the last 10, 12 years, so 10, 12 years back, it was just VCs, and then venture debt kind of came into the picture. And at around 2012, 13, which is slightly less expensive than that, but they would be very selective. So I think one of the things that has happened recently is a spate of venture debt funds have come in. And when there's so much raised there, that selection is also kind of they cannot afford to be as selective as they used to be. So I think venture debt definitely is a good idea. It's easier to get, and they typically ride along with the equity check. So if someone is doing equity investment, venture debt would also typically come in. In addition to that, in our business, in our line of working, as we gone to retail, etc. also, and as you can expect, being a player in a gold and diamond jewelry, it's asset heavy. So we have over time explored different options also. So okay, again, while before going to that, coming back to equity, I think in equity also there are different pockets that have now opened up. So over last 10 years, and 10 years back, it was all foreign money and I think names which are well known in international markets, like Sequoia, Excel, etc., who were operating in India. And then few hedge funds started coming in. And I think recently, one of the most interesting pockets of funding is the family funds. So a lot of families in India, a lot of people who have generally been in India, they have amassed wealth, and they are very open to actually investing startups. We look at Nykaa's cap table, I think almost all the initial cap table consisted of family offices. I have interacted with all. I generally feel the family office guys because they comes from operation side of the business also. So they're a lot more prudent, and they're generally not that they don't get swayed by all these funding cycles, etc. So they take a lot of good calls. So that might be an interesting pool of capital, though a part of equity capital itself. If you're in a business which is asset heavy, and let's say retail is a component of that, then franchisee capital is also something which you can explore. And a lot of retail businesses in India over the years have been built on that. In a way, if you look at pushing your trade payable cycles, in a way you are running your business on your vendors' capital also. If you can actually push your payables by 5 months, 6 months, and so on and so forth. And I think those are fundamentally true about a lot of businesses. But a lot of these startups, in fact, when I started up, I had no idea about a balance sheet also, honestly. Balance sheet is over time I've learned, but I have understood so there are different buckets of capital, they're different. So every business would require a certain balance sheet size. I'm saying the risk capital or risky capital should come from equity, no two ways about it. No matter what the cost. But you don't want to risk capital if you've taken it from bank on debt and so on. And then non-risky capital, like business as usual, like working capital cycles, etc. Those are, I think, best funded by, let's say, invoice discounting, or trade payables, or franchisees, or NBFC debt, or bank debt, etc., etc.
Thanks. Thank Gaurav. And Eshan, we've been talking about investors and kind of having risk plans in place. So what would you suggest some strategies for startups to effectively communicate, their resilience plans and reassure investors, in volatile circumstances, in terms of their long-term viability?
Thank you. I think that's a very pertinent question, the communication, right? And the how of the communication. Devang, I think there are 2 or 3 key aspects here. First of all, I think it is the ability of the founder to show the VCs and the investors that they are amenable to change, right? So whenever there's a downturn, right, it is not the best startup or the best company that survives. It is the company that reacts the fastest and reacts in the most efficient manner to the sudden change in consumer, because whenever there's a downturn, there is a change in consumer pain points, a consumer buying behavior, right? So whoever is able to adapt to that the fastest would survive. So I think one key aspect is that the founders should be able to demonstrate to the VCs that they have the ability to be, that they're agile, they're nimble, and they're amenable to change. I think the second aspect, and even more important, is to come in early, right? A lot of founders go back to their VCs really late when they have 6, 7, 8 months of runway left and say, hey, mera ye client shoot gaya, now my ARR is going to come down. Can you save me, right? I think the key is, as soon as you get the first hint that you could have problems, right, that is when you need to reach out to your VCs so that you have the right contingency plans in place. Not really wait till the downturn has burnt you out, because in my opinion, if in a startup all these 3 things are happening at the same time, then you're almost doomed. First is if your growth rate, if your revenue growth rate is declining, right? Second is if you're not able to cover your variable costs, which I mentioned, if you're CM2 negative. And third is if your runway left is just 6 or 7 months. If all 3 of these happen at the same time, it's very difficult to save you. So that's why I would say come in early. And the third part is, and this is where honestly I see a lot of founders struggle, it is just to be transparent, right? I think जो आपकी problem है, if you're losing customers, if you're struggling, be upfront to the VCs and tell them. A lot of founders think that if I communicate my problems to the VCs, it's going to be a buzz killer, right? It may impact my chances of raising the next round, right? But on the contrary, this would really strengthen your bond with the VCs. If you take the example of Slack, right? In 2013-14, it was almost dead, right? It started off as a gaming company. But then the founder actually went back to the investors and said, hey, I only have X months of runway left. Should I return your capital to you? On the contrary, the VC said, no, let's try and pivot. You're very good in gaming right now. Let's just have a gamble of a few more months and try something else. And Slack became what it is right now. So I think that's the advantage of the third aspect, which is be transparent and be upfront with the founders. So,
yeah. So we are almost out of time. So I'll just ask one final question, for everyone, which is on culture. I think with startups, culture are as important, and it is not, one founder, who's navigating through the downturns, but it is the entire company, that is, navigating through volatility and downturns. So how do you see the role of company culture in fostering resilience, adaptability, and employee model in times of, uncertainty, volatility, downturns?
I think we need to really understand that company is not run by an entrepreneur himself, right? Employees plays a vital role in taking the company where it is. So culture is actually acting as a backbone that supports an organization, in different times. I mean, it can be a time where you're earning a lot, or it can be downturns as well. So a strong culture cultivates an environment of resilience, and it also builds a sense of purpose among the employees. I mean, we need our employees to be felt that they are cared, respected, recognized at the right set of times. And basically, this feeling will actually be given back to entrepreneurs when the business faces a tough time. It's very important that employees genuinely they are cared for, and then the employees give it back. So that's their loyalty, productivity, willingness to actually support in extra hours or low pay scales in downturns. COVID was a different problem statement altogether, but I think a loyal employee stays with you for a very long time, irrespective. I mean, it's just sometime it's required to actually for you to actually spend the right amount of time for your employees.
Makes sense.
Feel culture is very okay. Beyond a certain scale, it's the employees, the people working, it's the entire team that actually take the business places. In the very beginning, it's just 5-10 people, and typically that's also a selective group, or such a small group that they all are aware of each other. They all know each other. They all kind of find the right way of working together and so on and so forth. And in small groups, it generally works. I think it's only when it becomes big and it keeps on growing. At that time, I think the importance of what culture is being populated, or what culture is established in the company, in the organization, actually is what decides how far it will go. And I've generally, one of the most difficult things to articulate. I mean, you kind of have a feeling about it, but one of the most difficult things to articulate. What I've generally seen is consistency. Just be consistent, whatever you are. The way you behave, if you just stay consistent, it will keep on percolating. And there's nothing right or wrong. And Reliance is a different culture, Tata is a different culture, they both are big corporations.
Right. Very concise, but I think very deep statement, Gaurav. Any thoughts on culture, Eshan, given that you've seen culture again a large company and through the lenses of a lot of other companies?
Yeah. So broadly, I totally agree with the insights given by Sandeep and Gaurav. But just to summarize, I would say that during times of downturns and economic adversity, there is generally a lot of restlessness amongst the workforce, because you start thinking, is my organization going to survive? Are there going to be cost cutting measures? Am I going to live through those? So those can also impact workforce productivity. So I think during these times, it becomes all the more important for the founders to have a very open and a very transparent dialogue with all of the employees, and ensure that everybody in the organization is moving along together towards the shared vision. So obviously culture is important, but in these kind of times, it becomes way more important than before.
Got it. Great. I think that brings us to an end to the webinar. Thank you. Thanks a lot. I really am grateful for your time. On discussing the topic on building resilient startups. Thanks a lot, and have a good day.
Thanks, Devang. Thanks, Sandeep.